We're just a couple hours away from an earnings report from what I told Alex is the most important stock on planet Earth. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. You don't lie. I mean, it's a quarter of all the 11% return we've gotten so far in the S&P.
It is the sun that we all orbit around these days.
And the Fed also.
Yeah.
But let's check where on market stand here. The S&P is down 0.5%. It's easy to talk solely about Nvidia, but I do want to hit those Fed minutes because that also moved markets as well. You had various participants saying they're willing to hike again if needed, and many questioning whether or not policy is restrictive enough. And then if I just skip down to the 2-year, you see yields moving higher by about 4 basis points, and the S&P took another leg lower, although we're off that lows of the session. Your quick check in Nvidia trading a little heavy into those numbers, but let's be honest, expectations are still pretty juicy. And Target, it's worst, falling the most since 2022. The discretionary spend is tepid. We know that, and yet Target still got pretty hit, Romaine.
Yeah, when you take a look at the earnings picture, we should point out that Nvidia earnings after the bell is largely actually going to mark the end of the current earnings season, as more than 96% of the S&P will have reported by the time the sun sets over Wall Street later tonight. The S&P as a whole, right now on track to post about 7.4% earnings growth for the period. Now, while that represents a deceleration from the prior quarter, it was still almost double the growth projected by analysts. And our team over at Bloomberg Intelligence, they see further improvement, citing an index of earnings revision momentum that right now is at its highest level since September. Now, on a sector basis, the big winner has been tech and consumer discretionary, which each posted 20+% EPS growth. But while the sector-based numbers do look good, there is a bit of concern the deeper you dive into it, particularly on the consumer side. Lowe's just yesterday posted sales declines amid weak demand for home renos and big-ticket purchases. Lululemon, struggling with its own slowdown in growth, said its chief product officer would be leaving and wouldn't be replaced. And then Target disappointed this morning when its earnings report suggested consumers are way choosier than before. Christina Hennington, Target's chief growth officer, said that while there is some consumer resiliency, the broader environment remains complicated, particularly when it comes to home products and appliances. Now, that means that the holding pattern in U.S. equities over the past few days now looks even more dependent on a big beat from big tech and specifically from chip maker Nvidia to really break it from those market doldrums. Remember, 3 years ago, Nvidia accounted for about 1% of the S&P stock weighting and now commands a more than 5% share, with Microsoft and Apple the only companies with greater representation. But that's where the comparison really ends. Nvidia's market gains dwarf that of its big tech brethren, responsible for 24% of the point gains in the S&P this year. That's almost triple the contribution of Microsoft and effectively 24 times the contribution of Apple, which has done nothing for the market so far this year.
And this is all our way of saying this is a big deal, and you should definitely pay attention. And it's a huge market cap, and it could move quite a bit, maybe 8% either way. So this also goes to show overall analyst consensus estimates. I want you to just ignore this for 1 second. So the yellow line is where we are right now for Nvidia's price target, and then the blue line is the 12-month consensus price, which now sits at over $1,000. And that just means that there's more room for Nvidia to come up to analyst targets. Now, we know, Romaine, Nvidia is set to make a lot of money. Let me just refresh you with two main estimates. They're expected to make about $24.69 billion in revenue in that first quarter, and that data center revenue, Romaine, is going to be just a little bit over $21 billion. They're going to do well. The question is just how much.
Yeah, looking right now at EPS of $5.65 and operating income $16 billion, adjusted gross margins estimated to be at 77%. Phenomenal indeed. John Vinh joining us right now, Managing Director and Equity Research Analyst at Keybanc Capital Markets, helping us kick us off to the close and, more importantly, kick us off to those Nvidia earnings. We know the numbers are going to be good by any sort of traditional metric, John, but what everyone really wants to know is how much further can this growth rate continue?
Yeah, we see quite a long-term runway for Nvidia here. You know, if I think about the setup, we think near-term demand for generative AI is extremely pretty strong. The thing that NVIDIA's got set up for it over the next several quarters is it's got a major product transition going. It's starting to release its next generation Blackwell GPUs that are going to start ramping in the second half of the year. The ASPs of these GPUs are going to be significantly higher. The performance is going to be significantly better. It's going to provide a roadmap for a pretty seamless transition for their for their customers. And then going into 2025, NVIDIA has recently at its GTC event released its GB200 next generation complete server rack architecture, which is, we think, going to be a game changer in terms of just kind of the ASP uplift that it's going to get with its customers going into 2025. So we definitely see this being very sustainable going forward.
There's a lot of upside, and I think a lot of people have identified those potential upsides. I know, John, as an analyst, you also have to look kind of at the bear case as well, sort of the potential pitfalls up ahead. We're still talking about a company that still has a lot of high operating expenses, a company that's still knee-deep in a gaming sector that has seen slow down, and there's a lot of concern about new entrants into the data space here. Which one of those elements here would give you the most worry?
I would say competition, right? If you kind of look at the implied gross margins that NVIDIA is getting on its data center business, it's 90% gross margins. That's outsized relative to its semiconductor peers. If I think about the broader semiconductor peer group, the median gross margins is 50%. Anything above 60% is considered best in class. So this is unheard of, right? I mean, these are typically software gross margins. So obviously, there's a market need for there to be a credible alternative second source. On the merchant side, obviously, you've got AMD ramping its MI300. And then, as you can see from all the recent announcements from all the major hyperscalers, AWS, Microsoft, Google, they are all attempting to develop their own silicon internally as an alternative to NVIDIA. That's probably the biggest source of risk at this point in time for the company.
Well, no doubt that's going to be, though, a bit of a time coming. So they have a bit of a runway there. Jonathan Golub over at UBS said that normally NVIDIA beats consensus forecast by an average of 20%. He looked at the last 4 quarters back in 2023. If NVIDIA doesn't beat by that kind of margin, what kind of shortfall do you think we see in the stock in the next couple hours?
I think it's going to be pretty limited, right? I think most long-term investors understand that despite some of these competitive concerns, that obviously you're looking at kind of them being a victim of law of large numbers. I think if there is a brief pullback, I think it's going to be short-lived. I think you're going to see investors who maybe missed some of this run-up come in and kind of support the stock here.
So either way, it'll be limited, and then we'll keep going from there. We've heard from a lot of its customers, though, that CapEx guidance, that they're increasing it, and a lot of that's going to be money in the pocket for NVIDIA. How long does it take for that kind of CapEx guidance from like a Meta to show up on the books and as revenue for NVIDIA?
I think you're seeing it, over the next several quarters. Like most of the hyperscalers have already come out and have already indicated that they're tracking at above or the high end of their CapEx guidance. We think, obviously, given the investment cycle that we're going through right now, that CapEx budgets are only going to trend higher going into 2025.
All right, John, really appreciate you taking time for us on what I'm certain is going to be a really busy day for you. John Vinh, he's Managing Director and Equity Research Analyst over at Keybanc Capital Markets. Particular coverage here on this day of NVIDIA. As we count you down to the closing bells, a lot more coming up here on the program, including a closer look at Lululemon. The shares plunging today after announcing leadership changes that are spooking investors. We're going to take a look at the challenges ahead.
Plus, we'll get insight on the health of the consumer amid the latest retail reports and the Fed minutes. Our guest is Vincent Reinhart, Chief Economist at Dreyfus and Mellon. And a major gamble for UK Prime Minister Rishi Sunak, calling for an earlier than expected general election, with his party trailing in the polls. We're going to take a closer look at the strategy in just a second. All that and more coming up in a bit. This is The Close on Bloomberg.
Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Now is the moment for Britain to choose its future. to decide whether we want to build on the progress we have made or risk going back to square one with no plan and no certainty. Earlier today, I spoke with His Majesty the King to request the dissolution of Parliament. The King has granted this request, and we will have a general election on the 4th of July.
That was UK Prime Minister Rishi Sunak in the rain, calling for an earlier than expected general election as his Conservative Party trails the opposition Labour Party in opinion polls. Joining us now, John Authors of Bloomberg Opinion, an expat over there from the UK. John, yes. Will we get a Keir Starmer Labour Party victory? And what is the significance of that? I mean, this would be a really big political change.
Yes, in terms of will we get a Keir Starmer victory, it's close to inconceivable that we won't get a victory. Polls can be wrong, but the Labour lead over the Conservatives has been so big for so long that there's just very hard to imagine what could turn it around at this point. What's fascinating is whether Keir Starmer can actually govern on his own. There are, the people might have decided they don't want the guys who are in there now, but it's not clear that he has sealed the deal, and there is this specific problem with the British electoral math, which is Scotland, 90% of whose MPs are currently for the Scottish National Party. The Scottish National Party is in a lot of trouble recently. If they lose half those seats or more, most of them would go to Labour, and then it becomes quite easy for Labour to get an overall majority. If the nationalists hold on, it becomes very hard indeed. You need to get a very big majority within England and Wales.
So, John, what was sort of the impetus, though, for this? I mean, why call this now?
Well, somebody very cruelly, in the clip we saw of him speaking in Downing Street, the music somebody was playing in the background was "Things Can Only Get Better," which was Tony Blair's campaign song from 1997. Somebody with a great vintage British sense of humour put that one on. The idea,
and you guys are known for your sense of humour.
Thank you. Yes.
Snarky sense of humour for sure.
Thank you. So in this case, though, I think it's almost the opposite. I think he is making a judgment, and whatever you think of him as a politician, his economic market judgment is pretty darn good. He was a very successful hedge fund manager. That things aren't going to get much better than this. I think. I'm sure that...
I hope that's not his campaign slogan.
Well, to be fair, an election had to be called by January 2025 anyway. So the idea that between now and then, they had to call an election, and if now's the best time to do it, then now's the best time to do it.
And for a while, the belief had been, well, we will have had 2 or 3 rate cuts by then, inflation will have come down, there might be some more of a growth. Hold on for longer, and people might begin to warm to the notion that the Conservatives are turning things around. We had today, they were indeed very low, 2.3% headline inflation is the best number in some years. But it was actually not as low as expected, and it means that the market has slashed the chance of a rate cut next month.
If we get a Labour government that can actually govern, what happens? Because that's going to be spend, right? I mean, the shock that we had back in 2022 with Theresa May was an exploding budget deficit where the bond market completely freaked out and had to reverse course. What happens under a Labour
I doubt it happens because Labour have bent over backwards to say that whoever we are, however bad we are not the second coming of Liz Truss. And in the the
Liz
current...
Truss, sorry, I said Theresa May.
Don't worry about it. The current finance secretary, the current shadow chancellor is Rachel Reeves, who is a former Bank of England economist. This is somebody who's criticised for being too orthodox, too cautious. Do I think that she can turn the economy around? Do I imagine that we have a transformation of the British economy coming? No, I find that almost as hard to imagine as a Sunak victory in July.
Yeah.
I don't see this being a vintage fiscal crisis or crisis of confidence in the incoming government because, and also you have the precedent of Tony Blair, that was a government that didn't necessarily achieve what it wanted to, but survived a very long time without causing any damage.
All right, John, authors of Bloomberg Opinion column. A discussion here Of course, about the big news coming out of the UK, Rishi Sunak, the Prime Minister over there, calling a special election, or calling a general election, I should say, on July 4th of this year, despite the fact that his party is trailing in the polls. So, gamble to be sure.
Or again, as we were talking about, maybe it's not going to get any better from here. So 2.3% inflation, that's really close to the Bank of England's target. So maybe that's not so bad, and it's okay to go there and say, all right, guys, re-elect me because, I don't know, something.
Yeah.
Whatever pitch they wind up making.
All right, we're going to keep an eye on that. Meanwhile, we're keeping an eye on the U.S. markets and some of the big U.S. movers, and that includes Lululemon having one of its worst days in about a year. We're going to talk to an analyst about what's adding to the athleisure brand's wall of worry. That's coming up next here on The Close. This is Bloomberg. All right, it's time to get a look at the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off with hims and hers. A downgrade today to neutral over at Citi. This after the telehealth platform announced plans to add those discounted weight loss injectables to its portfolio. Now, analyst Dan Grosslight said that while he was initially encouraged by the announcement, he's actually moving to the sidelines on the stock now because of what he sees as significant uncertainties around the economics and durability of those GLP-1 drugs. The shares moving lower by about 8%. Next up, let's take a look at Box, getting cut to equal weight over at Morgan Stanley, and the price target trimmed to 32 from 35 bucks a share. The cloud-based file sharing company faces prolonged macro challenges, currency headwinds as well. That's according to the analyst. He also says there's constant competitive overhang from that partnership with Microsoft, which he says could erode Box's growth opportunities. Those shares taking a leg lower, down about 2%. And finally, let's take a look at Shopify, an upgrade today to buy. This over at Goldman Sachs, with the analyst saying that the stock's year-to-date underperformance is actually creating a bit of an attractive entry point out there. She believes that Shopify has the chops to drive durable revenue growth at scale, given its innovative technology for e-commerce software. Those shares having a decent day, up about 2.5%, and those are some of our top calls. All right, we do want to stay in the retail space and take a little bit of a closer look right now at Lululemon, hitting a one-year low today after announcing changes to its leadership that really kind of rattled investors. The chief product officer over there, Sun Cho, is going to leave the company, and Lululemon says it has no intentions of actually replacing that role. Adding to what our next guest says is a wall of worry in the near term about the company's strategy. Rick Patel, senior research analyst over at Raymond James, joining us right now. He still has an overperform rating on the stock. And Rick, I want to get to sort of the chief product officer leaving and the decision to just kind of funnel those responsibilities, I guess, to some folks existing. It seems a little curious at a time when we know that the company had really been struggling with a decline in sales growth. And more importantly, they just don't have the same cachet on their products like they used to have.
Yeah, I mean, look, I think the stock is down right now because, we characterized it as a wall of worry, like you said, and it basically adds an element of, incremental risk and incremental unknown into a story that's been slowing down. And I think that's why you're seeing the stock react the way it is. I will say that, we also think that the company has a very strong bench from a product perspective. They brought in a new creative officer in January who has over a 30-year history, within various fashion brands. And the existing leadership that also reported into Sun Cho, including the chief merchandising officer, they're staying put, as is Nikki Neuberger, who reports directly to CEO Calvin McDonald. So, we think that, they have a strong leadership bench here on the product side, and they should be able to weather, this change, which is still a negative at the end of the day. But I think they're in a good position to maintain their momentum.
I am curious, at least in the short term, I think in about 2 weeks or so, maybe less than that, I think we're going to get Lululemon earnings. And we've seen that growth rate decelerate. I mean, they're still on the revenue side, I should say. And we've still seen double-digit growth, but not nearly what we had seen, particularly during the pandemic when they were posting 50, 60% growth rates here. What do you think is sort of a baseline of growth that you are comfortable with as an analyst, at least comfortable enough where you would maintain that overweight on the stock?
Yeah, so they guided for total revenue to be up in the 10 to 11% ballpark, and that's excluding a 53rd week that they have. And we do think that results can, meet and most likely exceed those expectations. And as I think about this story, I think there are drivers, both near term and long term, that can drive the story here. So in the near term, they have the momentum from new stores they built out last year, and this year they're growing their square footage by low double digits. These are incremental, new drivers of revenue that weren't there last year. And they also have an acceleration product innovation that's going on this year. So they talked about recently the launch of footwear on the men's side, that's going to add to the women's footwear side. And we have low expectations for that, but we do have bigger expectations for what I think are going to be new fabric platforms that are launching later this year. They have one coming out for yoga in time for the summer, and they have another one, totally new fabric coming out for the training category this fall. And historically, new fabric innovations have been a catalyst to drive traffic in the stores and to reinvigorate the brand. So they have a lot of things going on near term that we do think could make their sales a target of 10 to 11% likely beatable this year.
Wedbush was also talking about their, quote, hyper growth internationally could help mitigate whatever slower growth short term that the U.S. sees. Do you agree with that also?
We do, and I think international is really the key for the long-term story here. So, one of the reasons that we think Lulu has one of the clearest and most compelling runways for growth is the fact that it is underpenetrated in international markets. So when you think about a brand like Lulu, the international penetration is roughly 21% of total revenue. That's what it was in 2023. They have a target to get to 50% over time, and we do think that's very much achievable. We have seen companies that are a little bit further along the maturity curve, including Nike and Skechers, achieve revenue that's north of 55% of total business. So with Lulu, I think there's a lot of white space opportunity, particularly in China, where they can continue to drive very strong growth from new stores and increasing brand awareness.
So do you think the sell-off today is justified or / buy the dip, but kind of how much does it have to shake out a little bit?
Yeah, I think it reflects, an element of uncertainty into this story, right? So I think the reason why the stock is down is you have Sun Cho leaving, and look, she's been overseeing the product side for the last several years, and Lulu has been very successful for the last several years. And anytime you want to be successful in this space, you have to get the product right, the storytelling right, and the execution right. And they've done a really great job across the board. And you have this person that we think was instrumental that's leaving. So it does add uncertainty. I also think that the fact that they didn't reiterate guidance is also a negative. It's our understanding that it's not a sign that they're on track to miss expectations or anything like that. It's our understanding that when there's a material change in terms of a company event such as this, they have to disclose it within 4 days. And I think that's what we're seeing right now. So I don't think it's a negative sign that they're going to miss expectations, that, the fact that they didn't reiterate guidance.
Okay, that's interesting. We don't know yet, but maybe not such a revision worry. All right, Rick, thanks a lot, Rick Patel, over at Raymond James. Are you a Lululemon guy?
Nah, I got a couple things from them that I used to golf. They got a couple good shirts.
Well, the golf shirts, we've had this conversation.
Beyond that, I don't know.
We like the golf shirts. All right, Connor, Vincent Reinhart, Chief Economist at Dreyfus and Mellon, gives his insights on the Fed minutes and the health of the consumer. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So Lululemon, not the only stock that's getting hit. We talked about Target also falling the most since 2022. It was the commentary, Romaine, that really got to me. We'll talk about this in a second. But that cautious on near-term growth and discretionary spending is just tepid.
And it wasn't just Target, too. I think that's what, I think we've seen a lot of people kind of rattled. Yeah, Williams-Sonoma also this morning saying something similar. You had Lowe's yesterday also saying something similar. We had Macy's earlier this week also saying something similar. So, I mean, they're not saying it's all gloom and doom, but they're making it clear. I think, I'll just quote what Macy's said, what it was, like a choosier customer, I think was the phrase they used.
Yeah, and Target highlighting the home products and appliance area that's been really struggling, whereas the apparel may be finding a little bit of a bottom there. So staying on that, right, Target reported earnings, it definitely missed. We spoke to Liz Ann Saunders of Charles Schwab earlier, and we got her take on the state of the consumer right now.
This is increasingly, yet again, a sign of this bifurcation happening, whether it's between nominal and real, high-end consumer and low-end consumer, services versus the goods side, discretionary versus non-discretionary. And I think there's a reason why the consumer discretionary sector has been performing poorly, is we're now seeing more than just cracks in the facade of the consumer.
All right, let's get more insight here with Vincent Reinhart, Chief Economist at Dreyfus and Mellon. Vincent, great to see you. Are we seeing more than just facade cracks? Is that how you would categorize it?
So there's a couple things to note. One is these are earnings calls, and leadership has to lean into what they're worried about. And what they're worried about is the economy is going to slow. The Federal Reserve isn't going to be providing policy accommodations sometime soon. And they're worried, and they're letting you know that in advance. The second part of it is, think about the firms you heard. What did we learn about housing? Rates this high, rates high for a long time are taking a toll on housing, and that's going to therefore hit retailers differently.
And the big durable.
And then the last part is income inequality, the dispersion across households. The softness in the labor market at the edges are more about low-income households. What's the most notable thing about last year and this year? The capital gains. Guess who gets that? And so I think those are the big tensions that aren't surprising at an economy that is no longer just barreling ahead.
Which makes it obviously difficult for the Fed. David Solomon was speaking at Boston College earlier today. I don't know if you saw it, talking about that potentially he doesn't see a lot of data that's compelling to say that we're going to cut rates here. And then in the minutes, we learned that there are various members who were okay having to maybe do more tightening if need be. Are we in that place right now?
So first thing, full disclosure, I got out of Boston this morning, but it wasn't because David Solomon was come to town. The second part is, yes, Federal Reserve officials, when pressed, will say that, of course, we can raise rates if appropriate. Ask them in a follow-up what's appropriate, and it would be a mind-blowing disappointment in terms of inflation. They're telling you that it's part cheap talk, it's part just identifying their policy reaction function. We're not all one-sided. There are circumstances in which we'd raise rates. We didn't throw away those keys. But for the current outlook for 2024, not on the table. Why? Because policymakers really care about their credibility. And if you spent all this year leaning into ease, raising rates is a pretty high hurdle, especially when you got other instruments, i.e. their guidance. What they just tell us is, remember I said 3 rate cuts in 2024? Those are off the table. Remember I said rates would be a bit lower in 2025? You'll see the summary of economic projections dots come up. As long as they have that fallback to tighten monetary policy without actually raising the overnight rate, they'll take that.
Well, then that raises the question then when we do get the next summary of economic projections, do you anticipate we're going to see a significant change in the dots?
They evolve, right? And the plain fact is, last time round, we were on the bubble between 3/4 point cuts and 2/4 point cuts. What has been the news since? That's got to lead at least some of them to favor only 2. They could even go less than that.
Well, and we kind of saw that reflected in the minutes. When we've had, I lost count of how many Fed speakers we've had just in the last 3 days, and they all seem to be relatively singing from the same hymnal.
They really are talking from the same page.
I wonder. I don't know. I don't know if that's by choice or if Jay Powell got to them. But it raises the question: is there a risk of just standing still for a while, for the rest of the year?
So I think the assessment of the risk. There's a central tendency. What they learned was probably inclining them to say we don't have to ease quite as soon. But they also have to consider the risks. And if they go too early, they're in a really awful position of having to backtrack, which would be bad for their credibility. They wait a little too long, what's going to happen? The economy will slow unnecessarily, but disinflation will happen sooner. And meanwhile, you'll have guests on saying, there the Fed goes again. They're behind the curve. They're always behind the curve. It'll get priced in. So make the mistake that's less likely, less costly, easier to fix.
So what do they do, though, in that environment, about a K-shaped economy? Like, how do they keep the market on board with certain expectations without super loosening financial conditions, but also making sure that the bottom, which is kind of where we started this conversation, the discretionary and the lower income, don't get left aside?
So here's the bad news. The bad news: the Fed's got a dual mandate, but it only has the the luxury almost to say it of really pressing hard on aggregate demand to test the limits of maximum employment when it's sure that that prices are stable. And right now they are not confident of the path toward price stability, so they can't run backward the Bernanke, Yellen, and even early Powell experiment of running the labor market hot to benefit lower income households. You hear Jay Powell, he says it every time. I sincerely think he believes it. He'd like to have a better performing economy, a more inclusive economy, but if you haven't achieved price stability, you haven't achieved your main mission, and everything else will not perform as well.
And he's made that clear, that price stability is still the foundation of dealing with the inequalities that he talked about.
Exactly, because if prices aren't stable, those inequalities will only get worse over time. So it's the bedrock for doing better, but until you establish the foundation, you can't worry about that. So what you have to do is what they say. Acknowledge it, do research, push out the envelope of the data for our understanding, but basically at the end of the day, say core PCE's here, that's not where we need it to be.
But overall, have you been encouraged by their communication? Not necessarily saying you agree with it,
All
but
of the
have you been encouraged
communication?
by it?
So, well, it's a deep irony to what you said earlier, to what Alex just said. They're all speaking, but they're all saying the same thing. What did we just learn? And so I think there is a discipline among Fed speakers, and as a former staff person, I really appreciated discipline among those policymakers. But I don't know that how well they're conveying their range of concerns.
All right, Vince, always great to talk to you. Vincent Reinhart there, now chief economist over at Dreyfus and Mellon, and of course, formerly having worked in various positions at the Fed over the years, Alex. And it gets to, I think, a broader question too. Like, if we were going to get rate cuts or even a rate hike, I mean, isn't this now when they would have to start priming the market for this? Like, they're not just going to spring that on us, are they?
No, definitely not.
Okay.
But I do think the question of is monetary policy restrictive enough? Like, that conversation is coming to the foreground. You heard Mester, you heard Bostic, and that's a bit different than, we're going to hike, just not yet.
Okay, and when we're talking about this on a week where we had our Dow 40,000 hats and our S&P 5308 hats on, so I don't know. That's a big question for the ages here. A lot more coming up here on the close. We're going to take a look at Target and deeper dive into the consumer space, which we were just talking about a little while ago. The share is really taking it hard. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. A closer look at Target. The share is down about 8% right now. This after the retailer's first quarter results and outlook underwhelmed investors. Same-store sales falling for the fourth consecutive quarter. Abigail Doolittle joining us right now to put this all in perspective. Stock having their worst day in about a year and a half. And I was a little confused by this. The numbers weren't awful, but I thought some of the commentary seemed cautious, I guess is maybe the best way to put it. But we didn't necessarily see the same commentary out of some of their competitors like Walmart.
Agreed. And I think that the word that you just used was very good, underwhelming. It wasn't that it was awful or, a horrible miss. In fact, even the fact that the comp sales fell for a fourth quarter in a row, that was in line. But when you put it next to Walmart last week, they put up a good quarter. The outlook is strong, wealthier consumers going there for better deals, apparently going less to Target. But that cautious outlook you're talking about from Target also, they really emphasize that discretionary spending is under pressure in the near term. I don't think that we heard necessarily from Walmart, and that folks are buying fewer items for their homes and appliances. Something about Target, at least for me, I used to be a big Target shopper. Now, a piece of it is being in the city. The Target shops here, these mini ones, are like extravagant CVS's. I would rather just go to a CVS than a Target. But in the suburbs, I actually had the opportunity to go there, a week or two ago, and I had really no interest. The last few times I've been into Targets, it's been hard to tell what's going on there. A lot of stuff packed in, a lot of stuff missing. It's easier to go to a store where I know I'm going to be able to get what I want to get. Maybe other people are having that experience, that Target feeling that used to draw me in, and maybe they seem to be hot and cold with that feeling where they're just like like retailers, you talk about fashion right, just like retail right, and maybe they're just not hitting that right now.
What I also found interesting, though, is that they didn't, they did reaffirm their guidance. They didn't cut their guidance for the full year, which says that they're going to have a stronger back half, right? And I'm wondering where that winds up coming from. Their second quarter could be better because they had a product boycott with LGBTQ products last year. So that could help.
Totally
I wonder what's going to happen there.
It's so interesting that you're saying this, Alex, because that's my first thought too, because they're talking about going back to growth and yet they're cautious. There's not too much more of the year left. So it's like, where are you going to find this growth and holding the guide? So maybe they are holding some of it back. Maybe they are, like sandbagging a little bit around June because they don't know exactly how it's going to play out. On the other hand, like I was just talking about where there's weakness, where there's strength for them are, not surprisingly, well, beauty. That is one area where I might go in there because they have some interesting brands for sale. And then Taylor Swift, the new album, and then Diane Furstenberg. I mean, I used to actually buy clothing there. They would have really nice deals. So, these are some bright spots. Maybe that Target feeling will be back by the end of the year. But
the apparel side is holding up relatively well compared to, say, appliances, etc. All right, Abigail, thanks very much. Bloomberg's Abigail Doolittle joining us there. Coming up, we're counting down to the closing bell. We're about 45 minutes away from Nvidia earnings. We'll break it all down for you. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele with 10 minutes until we get to those closing bells. And it's less about the bells today, Alex, and more about what happens when we go beyond the bell.
It's about after the bell, absolutely. Yeah. So you got the S&P trading a little heavy, the NASDAQ trading 100 trading a little heavy, Nvidia trading a little heavy. But I just want to point out, energy is the worst performing sector on the S&P. Oil's getting really hit. So the cyclical guys are also getting hit as well, not just the Nvidia into earnings.
Yeah, absolutely here. And we talk about sort of the dependency of sort of some sort of upside catalyst to propel this market to fresh highs. Maybe we get that from Nvidia after the bell tonight. Investors weighing in right now on those high expectations.
For Nvidia, this is all about managing the expectation of how much growth there could be, because the market does expect them to constantly overperform. And it's just a matter of at what level of overperformance. So they have to really be careful about like how they guide for the next several quarters.
Nvidia, the bar is high, expectations are high, but I think they will beat and raise again. We think 2024 will be another banner year. We think data center revenues for them in the 90 billion plus. So they continue to execute well. We think that 90 billion will grow almost 4x in the next 5 years to almost 280 billion in data center revenues by 2027.
We see quite a long-term runway for Nvidia here. If I think about the setup, we think near-term demand for generative AI is extremely pretty strong. The thing that Nvidia's got set up for it over the next several quarters is it's got a major product transition going. It's starting to release its next generation Blackwell GPUs that are going to start ramping in the second half of the year. The ASPs of these GPUs are going to be significantly higher. The performance is going to be significantly better. We definitely see this being very sustainable going forward.
All right, some of the great voices we've had on Bloomberg Television today talking about those earnings out of Nvidia set to come after the bell tonight. Anthony Saglimbene joining us right now to count us down to those bells, chief market strategist over at Ameriprise Financial. And Anthony, I don't want to hype this up too much. I remember like 3 months ago, Scott Rubner over at Goldman basically called this like the most important stock on planet Earth. That might have been a little bit of an overstatement, but it certainly has a pretty outsized influence, not just in terms of its weighting, but really just on market psyche. How much of that psyche do you think is either going to be, I guess, helped or maybe even rattled by what we learned later tonight?
Yeah, I think your guests framed up what to expect here in a couple minutes coming out of Nvidia pretty well. Markets expect that sales grew by about 200% year over year. We've seen the last couple quarters, Nvidia has really surpassed analysts' expectations. Obviously, we're in the very early stages of the AI boom. And I do think it's about kind of meeting expectations where analysts are in terms of their Nvidia's revenue, but what are they saying about the future? And we know that many large companies, many large mega cap tech companies are making huge investments, huge capital expenditures in AI. Well, part of that is the revenue for Nvidia. And as we see their chips advance, as we see the next couple quarters of these trends improve, it's very likely Nvidia will be a likely winner of that. The one thing I would point out, though, is that by next quarter, the year-over-year comparisons are going to get harder. And so I think it is about managing expectations and relative to what they can see over the next couple quarters in terms of chips and meeting the demand for those chips.
I'm curious, broadly speaking, and particularly when it comes to AI and this whole push, and then more importantly, the CapEx and the other spending we've been seeing, there has been some concern that we might be getting to the point where we're sort of tapped out. The idea that the companies that really wanted to invest in this have already committed the money. The other companies that can't, they're still just going to be on the sidelines. And that's about all we're going to get. Do you worry at all that we could maybe see a slowdown in spending, whether it's on data centers, on the chips themselves, or the software?
Yeah, I kind of liken it to the early days of the internet boom, with one big caveat. You saw during the internet boom several mini kind of corrections as fiber optic was being put into the ground, as internet was coming on board, and computers were getting into the workforce and into people's lives in a more meaningful way. I think you could see that with AI, with very large companies being able to make the capital expenditures, build the large language models, put the money into the data centers and hyperscalers, and then over time, smaller companies will be able to tap into that technology and see the efficiencies and grow their revenue. I think from a more intermediate term, we're looking for profit growth to actually expand outside of just AI. So with a healthy economy, with the Fed potentially cutting interest rates later this year, you could see more cyclical areas tied to the economy start to see their profit growth improve, which means maybe the market rally that's been very narrow on big tech and some of these big, large companies like Nvidia could actually expand and start to include more of the financials and industrials and utilities. And we've started to see that a little bit this month.
Yeah, Anthony, I love that you brought it up. I feel like I've been harping on it for months at this point. But the utilities sector now feels very much tied to data center and AI expansion. And I'm wondering if the utility sector then is a growth sector, not just a safe haven. And then if we need to read that outperformance in a different way now.
Yeah, I don't think the fundamentals for utilities have changed much. They're largely a defensive sector. They're very interest rate sensitive. But what we've seen and what I think investors are coming to the realization of is if you have AI and you have these large language models that need to be trained in data centers and cloud computing, well, they use a lot of energy, and we need to make investments into our utility grid to make sure that AI has enough power to kind of push forward. However, I think fundamentally, when you look at just outside of the companies that are going to benefit from AI, I don't think the fundamentals have changed, but I do think that if interest rates start to moderate lower through the course of the year and the Fed can ease policy a little bit, I do think dividend-based type stocks, dividend-based strategies can start performing a little bit better as interest rates come down. It removes one of those big headwinds that I think have hurt utilities over the last 12 to 18 months.
All right, Anthony, always great to talk to you. Anthony Saglimbene, Chief Market Strategist over at Ameriprise Financial, helping us count us down to those closing bells. Just about 3 minutes to go here, Alex. And obviously a lot of eyes right now are going to be on the earnings out of Nvidia after the bell.
I'm excited.
Yeah.
I mean, I won't be here when that happens, but I'm still very excited. I think there was a great stat out that said that if we move maybe 8 or 9% the day after first quarter earnings, and if we do the same thing, we're looking at $200 billion move.
Yeah, are we setting ourselves up, though, for a big... I mean, we're, like, so excited about this, and I feel like it's just going to be like a dud, and they're going to be like,
I mean, but maybe, but if it's a dud, does that mean the stock does move 8%, and then we see $200 billion move in market cap? I mean, that's a lot of money.
I think one thing is certain. Whatever move we get tomorrow in the cash session is going to be in the billions.
Oh,
Whether it's
100%.
up and down. All right, we are moving closer to those closing bells. Stick with us. Full market coverage coming up of all those big earnings right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. Joined now by Scarlett Fu here in the TV studio. In the radio booth, Carol Masser and Tim Stenovic. As we parse all the crucial moments of the day, but who are we kidding? We're really going to parse the crucial moments that come after the bell. And that includes some big earnings, Carol, out of VF Corp, Elf Beauty, and Snowflake.
Yeah, exactly, man. Those are so important. And then there's this other one we might get to if we have time. Nvidia.
Oh, I've heard of them.
Yeah, exactly. Listen, the expectations are high. We're going to see, we've had all these stories about that. There isn't enough supply to meet demand. The numbers, the metrics, the margins, this is going to be important. And the outlook, we were talking to our own Ian King, that's going to be important.
Okay, the outlook, the revenue estimate, $26.82 billion. This is the one that I'm focused on. Adjusted gross margin estimate. Scarlett, 75.6%.
Yeah, that's something.
That is incredible. Just incredible. Yeah.
Ian shared with us, we asked for context around that number. He shared with us, for context, at the peak of Intel, when it owned the entire server market, it was in the 60%, in the 60s.
Low 60s, right?
Low 60s.
Yeah, that is just remarkable.
Incredible.
I wonder if that changes when Blackwell really comes into its own. Let's not forget, too, that the Fed is part of the trading day today because it's rare that Fed minutes actually move the market. But I feel like we've been in a holding pattern for so long now, basically a week, waiting for Nvidia. But we've been keying off Fed speak and the Fed minutes out of sheer boredom.
Yep. Many question whether policy was restricted enough. I think that tells you a lot.
All right, we get the closing bells here in New York on this Wednesday afternoon. The Dow Jones Industrial Average, the S&P and the NASDAQ all in the red here on the day, with the Dow down more than 200 points or about 0.5%. The S&P lower by about 14 points or so, or roughly about 0.25 percentage point. The NASDAQ down 31 points or 0.2%. The Russell also in the red here on the day, and that is your biggest laggard, at least among the big indexes, down about 0.8%.
All right, guys, just going to draw your attention to one sector. Solar stocks, man, they were just soaring in today's session. The Invesco Solar ETF up about 9% in today's session. UBS, a positive note today. New tariffs on Chinese solar panels and surging power demand. Overall, Scarlett, definitely playing into that factor. I'm going to have one of those among my gainers today.
Yeah, the ticker is the best, right? TAN.
Yep.
It just, whoever invented that, genius. Okay, let's take a look at the sector performances there. There is a lot of green on that pie, but that's mainly because the tech sector finished barely higher, up 0.1%. In fact, only 3 sectors finishing in the green: healthcare, industrials, and tech, but just barely. Your big laggards are energy, utilities, and materials, off by at least 1%.
All right, guys, we did get some retail. We are in the midst of retail earnings. TJX companies, way off its highs of the session when it was up more than 7%, but finishing the day with about a 3.5% gain. Did hit a record high, though. It boosted its earnings per share forecast for the full year. First quarter results better than many expected. That was according to Citi, but nonetheless, investors like that one. BuzzFeed, thank you, Tim. He said you got to do this one. Up 82% at its highs, finishing the day with a 20% gain. Mind you, it is a $3 stock, so any little dollar move or money move can be a lot percentage-wise. Soaring, though, after the entrepreneur and former U.S. presidential candidate Vivek Ramaswamy reported a stake in the company, asked for talks with the board. His stake, 7.7% in BuzzFeed, worth about $6.8 million based on yesterday's closing price, so we have to finish and do some math. But nonetheless, this would make him the 4th largest shareholder in BuzzFeed. So that was kind of an interesting story play. It is a $3.01 stock. For solar, I said solar outperformer. This is your number one gainer in the S&P 500 today, finishing up almost 19%. Yesterday, UBS raising its price target to 270 from 252. Stock closed just under 252 today. So there's optimism. There's some major macro efforts certainly going underway that are helping out some of the solar name. And I had to mention Moderna because this was a top performer in both the S&P and NASDAQ 100. More momentum in this name, finishing today with a gain of almost 14%. It's up something like 60% year to date, on track for, I think, a record streak of gains, which might have been today. I think it might be 8 in a row here. But nonetheless, they did announce some data that they're going to present at the 2024 ASCO. But I couldn't find any really other specific mover. But nonetheless, a lot of momentum on this play.
All right, you got the gainers, Carol. I'm going to go to the decliners. I do want to start with Target, a look at the retail space. We got earnings from the company this morning. Shares tumbling the most going back to November of 2022, falling 8% today. This after the company came out and they kind of sounded this note of caution when it came to discretionary spending in the coming months and with regard to its turnaround effort. Comp sales fell for the fourth consecutive quarter and declined 3.7% for the quarter through early May. That was in line with what Wall Street was estimating. Digital sales did help to moderate the drop, while brick and mortar comp store sales missed forecasts as attributed to a decline in traffic. Also, did you see what happened to shares of Lululemon, falling today by more than 7%? Shares are actually down more than 41% so far this year. They hit a 52-week low today, although they're the lowest since going back to March of 2023. This all because the company said its chief product officer, Sun Cho, was leaving, raised concerns among analysts that the athleisure brand was losing its edge. She will not actually be replaced. It's part of a bigger organizational reorg. Her responsibilities for product design are going to move to the company's global creative director. This according to a statement from Lululemon. And then for an honorable mention, Nvidia shares. I do want to take a look at how they finished the day, down about half a percentage point. They are higher by 91% so far this year. Really, it's just an excuse for me to talk about them ahead of earnings. Watching the most important number, the second quarter outlook, that revenue number, $26.82 billion, and then adjusted operating expenses estimate of $2.64 billion, adjusted gross margin estimate of $75.6 billion. The revenue estimate for the year should be, according to analyst estimates, about $113.83 billion. Those numbers expected around 4:20 Wall Street time.
That's a lot of money. It's fair to say.
It's so much money.
Making a lot of money.
It's near records right now, up 91% so far this year,
yeah.
Alex.
I'm taking a look at the bond market because it did actually move, particularly on the front end. We're seeing some selling yields up by about 4 basis points, a touch of buying coming in the back end. You did have a 20-year auction that went well despite any sort of rally into the numbers. And then you also had the Fed minutes. Many questioned whether policy was restricted enough, and various were willing to tighten more if need be. Plus, David Solomon of Goldman Sachs saying at Boston College that he doesn't see that the data is that compelling that we're going to have to cut rates. So the higher for longer narrative, but then taking a little bit a step further here. Like if policy is not restrictive, kind of then what?
All right, everybody. And we do have some earnings, it looks like, just crossing the Bloomberg terminal. Let me just pull it up on the terminal. We're talking about Snowflake just crossing first quarter adjusted diluted EPS. We're looking at 14 cents a share. So that's a nickel shy of the street estimate of 19 cents a share. But what's interesting, let's go to the outlook because it says it sees second quarter product revenue, $805 million to $810 million. That is above street estimates of $787.5 million. And we are already seeing this name popping in the aftermarket. It's up about 12%, down about 18% year to date. But again, another one of those software companies, but nonetheless, investors liking what they're seeing
and
on that outlook.
Yeah, absolutely. And a software company, we should point out, that has benefited from AI when you talk about just kind of the reimagining of these data centers, and they've been integral to that. It's kind of one of those kind of second tier AI names. It doesn't get talked about much, but we'll see. I mean, I want to dig a little bit deeper into the release to see how much, if at all, they're touting that.
All right, let's take a look at another company that just reported. We know it's the tail end of earnings season, so retailers are out in force. Here is an apparel and footwear company, VF Corp, right now. In terms of fourth quarter revenue, $2.37 billion, missing the mark here. Analysts were looking for $2.41 billion. So revenue missing analyst estimates. 2025 revenue seen growing 10%. I don't have a comparable, so we don't know if that's good or bad right off the bat. But right now, the initial read from investors is to push the stock down by 2.7%. This is not exactly a super liquid stock, so hard to say that we can read too much into it.
Big short too.
And just for prosperity here, it's North Face, it's Vans, it's these kind of names. They're also in the middle of a restructuring,
the teenage boys brand
in the U.S.
I think it's interesting. I mean, I'm glad you brought up those brands because I was looking through them. I mean, with the exception of North Face, I mean, they all had pretty significant declines on a year. I mean, 25% drop in Vans on their revenue side, 14 on Timberland, 15 on Dickies, and the North Face was up, but that was only by what, 1% or 2%?
That's barely up.
Yeah, well, brand direct-to-consumer up 6%, but the North Face was down 5% with ongoing U.S. wholesale weakness. Vans down 26%, largely consistent with the prior quarter, includes additional impact from deliberate actions to further right-size inventories in the wholesale channel, i.e. Put stuff on sale to get rid of the inventories that they have on back.
One other company I want to highlight here, guys, is e.l.f. Beauty. That stock just getting creamed in post-market. We're looking at earnings that on a earnings adjusted per share basis came in above estimates, but their net sales also did. But it's really about their outlook. Their 2025 adjusted outlook came in below estimates, whether you're looking at revenue, whether you're looking at earnings or adjusted EBITDA. So they're missing for this year. This goes against my whole invest in your face thing. I guess invest in your face has struggles also.
I don't know. How's Sephora doing? I don't know.
I mean, maybe we're not shopping on Elf Beauty, but anyway, that's not getting hit pretty hard.
All right. Right now, Nvidia just up a hair in the aftermarket ahead of its earnings, just up about 0.2%. So we'll be breaking all of those numbers down in about 10 minutes time, I know, on both sides. That's a wrap, guys. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. We'll see you again, same time, same place tomorrow.
All right, don't go anywhere, Nvidia. Those earnings set to cross the wire any moment now. We will have full coverage, instant analysis as soon as they cross, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. More tepid price action, but that could change by the time we get to tomorrow. And a big part of the reason is what's going to happen tonight. We are expecting to get Nvidia earnings at any moment now, crossing the wire as the market really kind of searches for direction coming off of those record highs. In S&P today, that closed down about 0.3%. And most of the broad market we saw actually slide just a little bit today. Some concerns about earnings, some concerns about interest rates. But you take a look at the Magnificent 7 index here at Bloomberg, down 0.6%. Of course, Nvidia, a big contributor to that. We did see a pullback in some of the commodities prices today, particularly in the metal space. A big drop today in copper and aluminum. And keep an eye in the crypto space. Ether, unchanged on the day, but that also could change, Scarlett, as we are expected to get a decision by the SEC on whether to approve those Ether-related ETFs.
Yeah, how often do you see Ether little change? It's usually big swings. All right, let's talk about some big swings among individual movers. Lululemon losing more than 7%, down for a sixth day, and in fact down about 37% since March 21st, when it disclosed a slowdown in U.S. store traffic as well as a weaker outlook. So the athleisure company says its chief product officer is leaving the company and she will not be replaced. Analysts are saying that this adds to the near-term wall of worry that perhaps the brand is losing its edge. Now, among gainers here, Analog Devices, ADI, at a record high, climbing 11% on the day. The chip device company had a beat and raise earnings report. It sees a resumption in growth from the automotive and industrial sectors. But when it comes down to it, what I'm watching this hour is one word: Nvidia. The poster child of the AI frenzy reports quarterly earnings, and expectations are high after 4 straight quarters of results that have blown past Wall Street estimates. The question is whether it loses any momentum before the release of its newest chip later this year. Would investors down the road be willing to overlook that cyclicality, or is this a stock that, having gained more than 500% since the start of 2023 and trading near a record high, really priced for perfection at this point?
And as we wait for those Nvidia earnings, a reminder that the AI ecosystem continues to get bigger and bigger. Our next guest is part of that ecosystem. Deon Nicholas. He is the co-founder and CEO of Forethought. It's a company that focuses on generative AI, but for customer support uses. And Deon, before we get into the nuts and bolts of your company, I do just want to ask you about just the overall growth of AI. We're also focused on Nvidia and what they've done, or at least how they've benefited from this movement. Is it now safe to say the AI, generative AI, and the practical application of it, whether by consumers or companies, that's here to stay?
Romaine, thanks for having me. And I fundamentally agree. I think that Gen AI is going to be the defining technology shift of our generation. And we're seeing this in a bunch of different applications, but what we're seeing is that businesses are trying to find the most important places to apply Gen AI, whether that's within their product, within their operations, or more specifically to their customer base for things like customer support, which is a big early use case for Gen AI.
All right. I just want to also just bring you some breaking news right now for our viewers. This involving News Corp and OpenAI. There's been a lot of talk here about the data and the intellectual property that OpenAI needs for its models. We're now learning that it has struck a multi-year global partnership with News Corp for its news content. Not quite seeing the terms yet. We'll get you some more details on that in a second. Still in conversation right now with Deon Nicholas. And just a reminder, Deon, just of how much this industry has grown. Talk a little bit about your company specifically and what it does. When we talk about customer support, I think for a lot of us, this is kind of our first sort of interaction with AI, if you will, at least from a sort of one-to-one perspective.
Yeah, absolutely. And I think that's true both for the consumers as well for as the businesses. Gen AI for customer support, I think, is actually going to be the single most impactful application of Gen AI right now. And we've all interacted with, the chatbots, the clunky decision tree, rule-based platforms of old. But applying Gen AI to this use case is proving to be extremely effective. And that's actually why we launched last week our AI and CX benchmark report, surveying hundreds of different business leaders across many different industries to figure out exactly how are they using Gen AI in customer support today, and how is that actually impacting the business. And that is core to our business here at Forethought.
So when it comes down to how the consumer experiences it, what's the difference between a chatbot and the Gen AI driven customer support? How will I know the difference?
Yeah, there's kind of been 3 iterations, what I would say, of Gen AI for support, or at least this chatbot world. So the old chatbots, if you ask a question like, hey, I just want my money back, they're not going to really understand how to respond because they've been trained by rules, decision trees, and keywords. And so they know if you say the word refund, they'll be able to issue a refund. But if you talk like a natural human, like most of us talk, they will just get into this doom loop of not understanding you. And we've all experienced that. And that's actually what's given chatbots and what's given AI a bad name for the past decade. There's now a modern wave of GPT-enabled wrappers that we call RAGs, or Retrieval Augmented Generation Systems. What they're doing is they're taking GPT and applying it to public knowledge articles, and they're able to answer questions almost like you were having a conversation with GPT, but instead of it making up an answer, it's based on the knowledge base. So that's the generation of the new wave of AI we're seeing here at Forethought. And then at Forethought, we're actually taking that a step further to what we call AI agents powered by generative AI. And the best example of this I can give is if you go to a support website and you ask the question, hey, I want to reset my password. A RAG-based AI, a GPT-based AI will have a nice conversation with you, and it'll give you, the 5 steps to resetting your password. Here they are. Thank you. Go on your way. But with an AI agent, what you're able to do is you get these AI that can say, okay, cool. Can you verify your email address? I've looked you up. I've just sent off the password reset link and send you on your merry way. The key idea here is that AI agents are able to hook into your deep data, your systems, and also take action just like a human agent would. And we think that is the future, and that's what we're seeing both at Forethought and in our benchmark report.
Okay, thank you for explaining the difference there, because I am one of those people who get really frustrated by the chatbot and just want to shut down all the browsers as soon as that happens. I've heard you say, Deon, as we await NVIDIA's earnings, that NVIDIA is the picks and shovels business of AI overall. If that's the case, how would you describe Forethought's role in the AI transformation?
Absolutely, right? So NVIDIA is the picks and shovels business. I think when you think about AI, all roads lead back to compute. Whether you're training models or whether you're using them for in-production inference, you're going to need access to that huge compute, whether that's through the cloud providers or directly on the hardware. And I think that's why NVIDIA is really rallying, and I'm hoping and expecting to see a big pop here as well. That being said, what is most important is that all of these businesses want to apply it, not at the foundational layer. Most people don't know how the AI models work, how the microchips work. They care about it for their consumers, or if you are a consumer, you care about it for your experience. And in that way, that is why customer support is going to be the single most important application of Gen AI in our recent history. And we're seeing, based on the benchmark report that we launched last week, that AI is here to stay. More than 54%, so that's more than half of businesses, have adopted AI in customer support in some way already of the folks we've surveyed, and even more are planning to do so in the next year. So we're seeing that this is a really early beachhead for AI adoption.
And just to be clear, Deon, when we talk about adoption and more importantly, the people who want this, is it just the companies, or are you also finding that the consumers, the folks who are on the end of this, that they're also going to be open to it?
Yes, we actually found that customer satisfaction scores actually go up when you're using the right kind of AI. It's actually surprising because we have been conditioned by this last decade of decision tree chatbots, as mentioned earlier, to have clunky experiences with AI and really clunky experiences with bots. And so we all assume, hey, if I see a bot, I just want to talk to a human. I just want to talk to an agent. But with this latest wave of AI agents based on deep data, GPT, or proprietary models like Forethought's, we're actually finding that the customer experience has risen and the expectations have risen. People like having a GPT-like experience where you can talk to an AI that's a little bit witty, that knows what's going on, that's embedded into the data, and can actually resolve your issue. At the end of the day, we want resolutions, not just runarounds.
All right, Deon, great stuff here. Really well said on everything. Deon Nicholas, we're going to have to leave it there. Co-founder and CEO of Forethought, generative AI company focusing in on the customer service experience. As, of course, we wait for Nvidia, which has been the poster child for the AI boom. Those earnings now crossing the wire here. The revenue, big, $26 billion in the most recent quarter. That exceeds the street estimates by more than $1 billion. The street was looking for $24.7 billion, so a beat of about $1.4 billion on that. Adjusted gross margin, also a beat, 78.9%. The street was looking for 77%. And then we should also point out the company is saying for its guidance going forward here, Scarlett, on the revenue side, that they see $28 billion for the second quarter in revenue, plus or minus 2%. That would also be a beat over what the street was looking for at about $26.8 billion. Oh, and another big headline here, Scarlett, a 10-for-1 forward stock split.
That's what got my attention.
Effective on June 7th. So in a couple of weeks here, they're going to split the stock, which of course right now is trading at $989.
Almost $1,000. So they're splitting the stock 10-for-1. That doesn't actually change anything if you're an Nvidia shareholder, but it may make it more palatable to new investors who want to get in on the action. Also, Nvidia raising its cash dividend as well on a post-split basis, but it's by 150%. So this is a business that's generating a lot of cash, and it's going to now return some of that cash to shareholders in the form of a dividend. I'd be interested to see if there's going to be an increase in buyback as well.
Interesting. And they are holding on to some of that cash. I'm looking at the R&D expenses up 45% here, which I guess makes sense given what they've been investing in. Operating expenses, though, also moving higher, up about 43%. We talked to John Vinh earlier, raising some concerns about that. Ed Ludlow, the co-host of Bloomberg Technology, joining us right now. Talk a little bit more about this. On the surface, Ed, not a surprise, but certainly pleasant. Strong revenue growth, strong margin growth. I guess if you buy into stock splits, that could be a positive as well.
All that matters is the data center revenues in the quarter gone being above expectations and being slightly above the guide that they've given for the fiscal first quarter. The second quarter, fiscal second quarter outlook of 28 billion plus or minus 2% is basically bang on street consensus. But the overarching idea is that everything continues. The sort of euphoria and hype around the stock that's been predicated on the idea that investment in high-performance GPUs, which largely come from Nvidia, is continuing, shows up in the financial guide that they're giving. We need to look deeper on commentary for supply issues because they are beholden to TSMC, and we want to know what the supply picture is. And we do need to understand better the situation in China. So we'll read through the earnings statement and also the CFO commentary document, but the numbers in and of themselves are strong, and the stock up 4%. It's a bit of a relief, I think.
You know what? I managed to find one number that missed the consensus estimate, and that would be, actually, you know what? No, gaming revenue, $2.6 billion, just a little bit shy of $2.62 billion, but that is no longer the driver of its business. I mean, that's the amazing thing about Nvidia, Ed Ludlow, which is that it's kind of been at the forefront of every big wave in technology, right? It was gaming, then it was crypto mining, and now it's AI. What are you hearing from Jensen Huang in terms of how long this AI wave will last?
4, 5, 7, 9, 10.
Nvidia gets a little credit for being early on the idea that GPUs, graphics processing units, would be useful in running multiple data programs in parallel. That's how you train large language models. What's reflected in these results and the commentary from Jensen in the release is that more sections of our economy are finding that useful. The market, frankly, has been very narrow and limited to the hyperscalers and Meta buying the GPUs in large volumes, the H100 generation.
1, 2, 3, 4, 5.
Move to SMEs, to government.
Yeah. All right, Ed, we're going to have to, I'm sorry to interrupt you, Ed. We're having some audio issues here. Ed Ludlow, the co-host of Bloomberg Technology. We continue our fast and furious coverage of Nvidia earnings crossing the wire. A big beat on revenue, a big beat when it comes to margins and profitability, and the guidance going forward also seeming to come in above expectation. Shares higher here in after hours trading. Let's get some perspective out of Melissa Otto, head of TMT research over at Visible Alpha. What jumped out at you most about this, Melissa? Is this about, I guess, the longevity, the resiliency here of this growth story?
I mean, they just continue to deliver. It's an interesting time. The stock's at an interesting nexus point. We're excited to see what they say on the call, particularly about their B series. But in terms of their guidance, which I think is what the market was probably really focused on, and as is evidenced by the behavior in the aftermarket, we were looking, based on Visible Alpha consensus, we were looking for $27 billion in total revenues. The company coming out and saying plus or minus 2% of 28 is solid. We're keen to hear what the trajectory is going to be for that B series.
Okay, and of course, the data center revenue number is the one that everyone's paying attention to because that's the part of the business that is the heart of the AI chip making part of it. So $22.6 billion, the consensus was for 21.06. Is that good enough?
It's a solid number. I think what's going to be more important and what the market's going to really focus on is what the guidance is going to trickle down into for the data centers. Right now, data centers make up about 85% of total revenues. Is that going to continue? Is that going to accelerate going forward? And then how is the new B series category going to contribute to that? And what is the timing of that going to be? How is it going to hit the quarters? And how should we anticipate that? These are going to be some of the important questions analysts are going to be asking.
Where do you want to see them do next, Melissa? I mean, we're talking about a company. I mean, we're so focused on the revenue numbers and even the profitability. This is a company that just generated about $14-15 billion in cash alone. They're sitting on another huge pile of cash. And I know some of that has to be reinvested into the business. And I'm sure all the, hungry investors out there will demand their pound as well. But at some point, they've got to think about what they want to do with this, whether that means new businesses, new product lines, or I don't know, maybe just something completely out of left field.
I mean, listening to Jensen Huang talk and present at numerous conferences, I mean, his vision is to essentially bring automation and robotics and the triangulation with artificial intelligence really to every industry, every business, every enterprise, every human. And I think, the sky's the limit in terms of the market opportunity for that. Now, to bring it back down to earth, it's going to be really interesting to see how these translate into viable businesses that enable that type of vision to really happen so that the CapEx can continue. So what we've seen right now is that hyperscalers, cloud service providers, essentially have been driving a lot of the CapEx, have been enabling a lot of this growth to happen. The next leg of growth is really for generative AI to happen within enterprises. And then I think we start to get into this really interesting place where it goes into manufacturing and we start to think about it from more of an industrial perspective. So, let's see if that all transpires over the next 3 to 5 years. I think that's the long-term investment case.
We know that investors have bid up Nvidia in part because it's really the only game in town when it comes to making money off of AI as opposed to trying to get a piece of the pie like its peers are trying to do, or even, just trying to shoehorn the word AI into its earnings calls. How valuable, Melissa, is that head start that Nvidia has? How would you quantify it?
I mean, head start is one thing. It's an interesting point, but I think the way we've been really thinking about it is that what NVIDIA really provides is a solution. And it's enabling data centers to really transform themselves to accelerated computing. And that's what's enabling generative AI to even happen. This is the really exciting thing and differentiator that NVIDIA brings to the market. This is what makes them so competitive, is that they're the ones that are enabling generative AI to essentially come to the world and potentially to change our lives.
How do we sort of, though, when we start to talk about AI as an investable asset class, rather than just one or two stocks, which seems to be where everyone has gravitated to. Where do you think those opportunities are going to be, Melissa?
Yeah, that's an interesting perspective. AI is everybody. You hear these, buzzwords. Oh, AI is going to transform the whole world. It's the most important thing of our generation. And I think what I'm really looking for is that AI moment that we saw with the iPhone, where when consumers got their hands on the iPhone, it was this aha transformative moment where the whole world just went bonkers and said, I need to get one of these. This is going to transform my life. And in addition to that, you had a developer community that started producing apps at lightning speed that also changed our lives. So not only did you have hardware that was in the palm of a user's hand, but then you had software essentially that got married with that and expanded very rapidly. So I think, one of the things I'm looking for is to see how generative AI is actually going to start to transform people's lives. Like, how does it make my life better? How does it make me faster, more intelligent?
Yeah.
How do I create a better Melissa?
Yeah, well, trust me, Melissa, I've been asking myself that question for the last 50 years. But anyway, always great to get your perspective. Melissa Otto over at Visible Alpha, a closer look at those earnings out at Nvidia. And we stick with that, too, because to really understand how in the span of just about 31 years, Nvidia went from a startup to the third most valuable public company in the world, you have to take a look at one of its biggest failures. So let's go back in history to 1998, because it was on this day, 26 years ago, that Microsoft and Japanese video game maker Sega announced that they were collaborating on a console called Dreamcast. The big selling point of the machine was going to be a high-definition graphics, which was crucial at the time as video games were shifting from two-dimensional to more realistic and complicated 3D formats. Enter Jensen Huang. Still in his 30s at the time, he had just started NVIDIA with two fellow engineers a few years prior in 1993 after recognizing the need for specialized processors to improve the look and speed of video games. Sega tapped the fledgling company to build the graphics processing unit for the Dreamcast. But those initial chips, they were a flop, big time. Huang made a huge error, a huge one, by betting on a novel technology for rendering images using quadrilaterals. Now, we're not going to get too wonky here, but the decision was wildly unpopular with game developers who had preferred to use image renderings using triangles. In layman's terms, NVIDIA effectively delivered a high-powered GPU to Sega, but the people who actually make those games had no real use for it. Now, that misstep forced Sega to make a decision to abandon NVIDIA and use GPUs from a competitor. At the time, NVIDIA was still a private company and had been burning through cash, and there were a lot of doubts about its future. Jensen Huang realized that without the Sega contract, NVIDIA might not survive. So he supposedly asked the CEO of Sega's America business to still pay him the $5 million from that contract. That executive initially refused, but later agreed to make a $5 million investment in NVIDIA. Now, unbeknownst to anyone, it was a lifeline that would lay the foundation for the company's rise to dominance. That $5 million, along with some heavy layoffs, bought Huang several extra months to redevelop those chips, and this time, he didn't disappoint. His new design appealed directly to computer makers Dell and Gateway. That was enough to help NVIDIA IPO in early 1999, and later that year to release the GeoForce 256, which in terms of speed, motion, and blending was the most advanced GPU option on the market then by a wide margin, and still is today. Eventually, NVIDIA got another shot at gaming consoles, developing the graphics hardware for Microsoft's Xbox in the year 2000. It's interesting today to see how Jensen Huang speaks with pride about those missteps, joking to Bloomberg just recently that he almost went out of business 7 times. Now, 7 might be a bit of an overstatement, but what can't be overstated is the phenomenal success of the company that Jensen Huang founded 31 years ago, a company that rode the rise of video gaming to untold riches and is now riding the wave of AI even further, right now controlling 80% of the market today for data center accelerator chips.
How timely that you got that data point from the 90s.
Yeah.
What's interesting, of course, is that $5 million investment. You think that guy still has it in there?
Well, no. He actually left the company, and it was actually Sega owned the stake, and they sold it a few years later for guess how much? 15 million. So they tripled their investment, but I think if they were looking back today from them, they're like, oh gosh, we should have held on.
Exactly.
But,
it's always, getting out is always a risk because how do you get back in? All right, let's continue our discussion of chips and technology and specifically how it's affecting the future of the auto sector. Joining us now is David Welsh, Bloomberg's Detroit bureau chief. And David, we talk a lot about chips and their use in self-driving vehicles. We haven't gotten to that point yet. But when it comes to vehicles and the next generation of vehicles, we, and I say collectively, we seem less excited about electric vehicles overall and just more keyed in on hybrids. Now, there are different kinds of hybrids, plug-ins or not. Where are we at in terms of the adoption of hybrids versus plug-in hybrids?
Hybrids have had pretty strong sales for the past year and actually prior to that, but it's really accelerated now. As gasoline gets expensive, it's an easy way for people to get a vehicle that's a lot more efficient. They don't cost a lot more than a stock internal combustion vehicle, so consumers really like them. Automakers have sort of questioned or muse, let's say, whether or not it's a sort of a gateway vehicle to an electric. I don't think it is because it still runs on gasoline and you never have you never really have to kind of plan your trips and so forth to make sure you always have a charge. You can always rely on gasoline. But look, they're very popular for that reason. You get great mileage. You can drive. Geez, some of these can go 500 plus miles, 600 miles on a full tank, and consumers like that because ultimately no one really likes going to the gas station. But you're never totally out. And Toyota's done very well with them for a long time. And because EV adoption, look, EV sales are still growing, but because adoption is slowing down, automakers, including General Motors, are having to give this a relook. They didn't want to do it before because they're expensive to build, but they're going to have to because consumers are headed there and they've got to respond to the market.
Well, I mean, where we stand, though, in the trend, though, now, David? Because, I mean, there's been so much talk about this, and it's hard to kind of know what's real. I mean, we've seen some of the numbers. We know there's a slowdown here. But is this just kind of like one of those, I guess, temporary bumps, if you will, as the industry tries to sort it out? I mean, these big automakers, I mean, we know, like, the Teslas and those companies are committed to this. But the big automakers, I mean, they're not abandoning this altogether. They're just basically retrenching a bit to try to maybe figure out a better economic model?
That's right. Look, in the first quarter, according to vehicle registrations, at retail, EV sales in the U.S., which is the slowest market for EV growth, we're up 9%. That's not bad. This is still a growing market. A lot of this is being confused because sales growth was 50% not long ago, and now it's slowed down to only 9%, which is not bad. And Tesla's had its struggles. I think that's largely because other than the Cybertruck, which does not sell very well, the other vehicles have been on the market for a while with the same styling, and they're kind of stale. Another issue that's really slowing things down is basically most EVs right now out there are expensive. They're essentially luxury vehicles. We're only starting now to see some more affordable EVs come to market. And look, I think the test case is going to be the Chevy Equinox EV, which GM just showed off recently. They're going to have a version that sells for $35,000 at 320 miles of range coming out. Yeah. That's going to tell us whether or not the mass market consumer is ready to go electric, just how the market reacts to that. And I think they'll sell some because the price is good. $35,000, that's before the government tax credit, so and it'll qualify for that. So the vehicle's actually going to sell for $27,500 after the tax credit. And that's a very attractive price. If your non-luxury buyer, your average car buyer, is going to buy those in big numbers, then we could see another wave of growth because other companies will come out with affordable EVs as well.
All right, David Welch, Bloomberg's Detroit bureau chief. There, a closer look at the EV market, and we take a deeper dive into that and how technology really is changing the auto sector. Jon McNeill is the CEO and co-founder of the venture capital firm DVX Ventures. He's a serial entrepreneur. He also serves on the board of General Motors and is the former COO over at Lyft and the former president over at Tesla. Needless to say, you know a lot about what's going on in this industry. And I want to first start with this narrative out there right now about this slowdown in EV adoption. I know there's a lot of anecdotal evidence of people concerned about range, concerned about prices, et cetera here. But do you see any sort of meaningful or structural shift in the way that we're thinking about EV adoption?
I think I don't, and the reason is David just cited that the sales were up 9% in the first quarter, and in the first quarter we all knew that there was going to be a big hit to sales because most of the cars had lost their federal tax credit in the first quarter. They gained them back now in the second quarter. So consumers are smart; they know they can wait a few months and save $7,500. They're going to do it, and they did. But sales were still up. As David noted.
Talk about the technology. I mean, I think one of the things that captivated, particularly when Tesla came on the scene, it wasn't so much the build of the car. It was really the software, the technology that went into it, I think wowed a lot of people. And we've seen that technology fan out to the big automakers. They're using it not just in the EVs, but in regular, gas cars as well here. When you talk about how fast that technology came to fruition, where does it go next? Or let me rephrase that, where does it need to go next to make the cars better and maybe potentially cheaper?
Well, I think as you step back and say what's going to happen in the overall ecosystem, it gets pretty interesting. And so at DVX Ventures, we're working on how to make charging more reliable and more available. We're working on mobile service, which now EV customers demand and expect. We're introducing technology into the buying experience, as people want to educate themselves about what it means to own an EV. So you've got technology that's happening within the car and then technology that's happening outside of the car too. And we're doing a lot of work at that second level at DVX, but clearly GM and others are really very serious about the technology that's inside the car.
I want to back out a little bit and go back to something you said, which was the government incentives. And how they went away for a while, they're due to come back. Is this an industry, the EV industry, that can stand on its own without government incentives for the long term?
I think eventually, yes. There's this bridging that happens, and we watched the Chinese government really effectively subsidize their industry so that they could get down the cost curve and produce at a very low cost. Now, as we look at that competitively across the landscape, geopolitically, we say in the U.S., we need some policy that is going to assist the U.S. automakers to get to that same spot. And so that's where the incentives come in. But will they be necessary forever? Probably not, because as the U.S. automakers come down that cost curve, then the prices for vehicles are going to get lower and more compelling. And GM is introducing this post-incentive Chevy Equinox that is $27,500 and is a really compelling car. It's got 300 plus miles of range.
So when you look at what GM is doing, compare and contrast GM's approach to self-driving vehicles, to driver monitoring systems versus your previous employer, Tesla.
I think there's a safety-first mentality that Mary Barra, Mark Royce, and the team brought into GM as they came into their executive roles. They inherited the ignition switch controversy, and they said to themselves, never again. And so they put safety first. And so I think you see that now with the rollout of self-driving technology, where there is a safety-first mentality, both at GM and at Cruise. And they're really working to help transition the GM, to the Cruise culture into that GM mentality of safety first.
So GM's still committed to this, to self-driving. So you think, are we going to see a Cruise or GM-related robo-taxi or something?
Well, those Cruise cars are now back out on the roads and for testing, and now they're heading back to getting back on mission, which is full autonomy, full robo-taxi autonomy out on the roads, which they've generated more miles than anybody else in the space as a full robotaxi.
Well, you mentioned doing this safely, though. There's been a lot of criticism about some of these programs, both at GM, obviously at Tesla. There's been a lot in the news right now about the self-driving capabilities at Tesla, how they were rolled out, whether they were rolled out too fast, whether they complied with regulations here. Are we doing this in a way? I understand the technology and the thirst to sort of move us forward as a people, but is this being done in a safe way?
I think we're really concentrating on that at Cruise. I can't speak to some of the others, but at Cruise, we're very much focused on this is a necessary technology. There are people that can't be mobile without this technology. So we're going to enable people who are blind to be able to take their first ride in a car by themselves. But we've got to do that responsibly, and we've got to do that with a safety-first mentality. And I think the bar has been raised over the last 5 or 6 months in terms of what that means.
But you were at Tesla at the time when they were also rolling this out in 2015, 2016, whenever you were a president here. Was that same level of safety there then?
I think there it was much more of a mentality of let's get the technology out and start the feedback loop. And I see a very different approach at Cruise.
Do investors and consumers just need to be more patient when it comes to the next iteration of self-driving EVs and everything that we've kind of been promised, but it's been slow to actually come to fruition?
The road to autonomy has been this climb up a mountain with a number of false summits. You think you're getting there, and all of a sudden you crest and you find there's another summit 1,000 feet above you. And so I think there's a saying that for folks that work in this technology that we're 90% through, but the next 10% is as big as the first 90%. And that has been repeated several times. We're having breakthroughs in technology that are getting us closer and closer and closer. So I think we're going to see this over the next few years, but it's going to be a few years.
Okay, so if you were to liken it to a baseball game, we might be in the 8th inning, but we could head into extra innings.
Exactly.
All right.
Yeah.
Jon McNeill, CEO and co-founder of the venture capital firm DVX Ventures. Of course, he's also tied to GM and was formerly president of Tesla as well. Let's take a look at how markets closed on the day. Romain, it was a waiting game all day long, waiting for Nvidia results. We did get them, and Nvidia delivered as expected.
Yeah, they delivered. Here's the sad part, though, Scarlett. I was looking at S&P futures and NASDAQ futures for tomorrow. Not a huge pop here in after-hours trading. So whatever.
They didn't deliver enough?
So whatever. Well, they're delivering for themselves, but I'm not sure it's going to deliver for the broader market. Nvidia doing well in after-hours trading, but I don't think the futures are keeping pace.
Yeah, we just need the Fed to cut rates, right?
Yeah.
Okay, well, that's all it takes. This is the close on Bloomberg.
All right, some breaking news. This involving DuPont, a new CEO and a separation of the company into 3 separate entities. That story crossing the wire right now. CEO Ed Breen, remember, he was chairman of this company. He took over as interim CEO back in, I believe, 2020, 2021, has been serving as CEO ever since. We're now learning that DuPont has said that it plans to break apart into 3 publicly traded companies. And of course, they will have new CEOs running each one of those companies. Ed Breen will step aside on June 1st, though he will stay on with the company as executive chairman as they sort of work through this transition. I think this is interesting, Scarlett, because we saw this with GE. We've seen this with the other couple of big industrial conglomerates. This idea here that old conglomerate model just doesn't work, at least not for our investors anymore.
Right. And the idea was that if one business doesn't do well, the other one will hold up, and that will kind of provide some smoothness to earnings. In this case, DuPont will separate its electronics and water units through different tax-free transactions. It'll also have a business that focuses on the biopharma and medical device industries. And of course, when I saw this headline, I was surprised because wasn't there a Dow DuPont not so long ago?
Yeah, I mean, these companies have gone through a lot of iterations. And it's interesting, too, because, I'm fascinated by Ed Breen. I used to cover him a lot back in his old Motorola days, and then he was at Tyco. And this is kind of in his playbook. But it's kind of interesting. In the old days, he was kind of putting all these companies together. But he was always that consummate deal maker, either buying or divesting. And so I guess this is going to turn out to be one great, not quite a divestment, I guess that's not the right phrase, but certainly a great big reorganization.
Yeah, spin-off, what have you.
Yeah.
That's a good point, that history that he combines companies, and that was in the era when it was popular to do so, and investors rewarded you for that. And now investors clearly rewarding companies for slimming down and being really, really hyper-focused on one business so that there's visibility into it, as opposed to being able to hide weakness in one division with better numbers in another division.
Yeah, and it raises the question, though, too, is, when GE spun off, right? You had the main one do well, which is mainly like airplane stuff, right? But then a couple of the other ones, I forget all the names, they're all like GE Canova or something like that.
Yeah, there's one with a V word at the beginning.
Yeah, but a couple of them are kind of like, they haven't done all that.
And maybe
great,
that's why they needed to spin it off.
Yeah.
They saved the best one with the GE name.
What does this name get? Does it go back to Dow? DD, DuPont?
Maybe.
Who knows? Anyway, all right, a storied company here with a storied history now seeking to reorganize into 3 separate companies. Stick with us here. A lot more coming up on the close, including some of the big, potential big market moving events over the next 24 hours. This is Bloomberg. All right, let's set you up for some of the potentially big market moving events over the next 24 hours. That includes some earnings. We had some retail earnings today. We get another one tomorrow out of Ross Stores. Mary Ross Gilbert joining us right now, senior equity research analyst over at Bloomberg Intelligence. Talk a little bit more about this. Very apropos, I guess, given your middle name there, Mary. But let's get right to it here. Roughly 3% comp sales growth. And I'm curious as to how you look at that, particularly against the backdrop of what we heard from some other retailers already.
Yeah, so for Ross Stores, we're expecting them to beat their guidance. But what we did see from TJX this morning is that they came in lighter on the comp sales side and actually beat on the earnings side. But for Ross, they're doing a really good job in bringing in that trade down consumer from department stores and specialty stores. What they're doing is they're bringing in more recognizable brands like a Michael Kors, a Tumi, and then they're going ahead and marking it. They're marking it down at a sharper price point. So they're willing to sacrifice a little bit of margin to get the traffic, and they've been successful in doing that as they did in the fourth quarter. And so we're going to be looking for some commentary there. The reason for TJX being light on the comp sales side, they met the high end of their guidance, is because of weather. So we'll see if they were also impacted by weather.
Right, but Ross we don't see it here on the East Coast. I know it's very prevalent in California. Does Ross Stores just end up being a read on the California consumer?
Yeah, that California is a big market for them, as is Texas. So you could have some weather differences there because they definitely have a lot of volatility in weather. But yeah, for California, we did have a more rainy season. We don't typically get rain, especially in Southern California. But this year, wow, we've had more rain than we've had in multiple years. Yeah. So that could have had an impact.
All right, Mary, going to have to leave it there. Mary Ross Gilbert over at Bloomberg Intelligence, a closer look at earnings out of Ross as we set you up for what to watch tomorrow. In addition to that, we have some rate decisions around the world. Not the Fed, not the ECB, but some other names.
Not the BOE either. Yeah, South Korea is seen holding rates unchanged. Egypt is also seen holding rates unchanged, but Chile is seen cutting rates for a seventh time.
So the seventh time.
A seventh time.
I missed the first six.
Yeah.
We're also going to get the G7 finance chief and central banker meetings gathering in Italy.
Yeah, and watch for the possibility of a deal that's been proposed by the U.S. to tap frozen Russian assets to help Ukraine. France is now on board. Germany's warming up to the idea. Maybe there's going to be a deal.
All right, and we do get some more earnings tomorrow. We get a big Chinese company, Xiaomi, and we get TD Bank, Ralph Lauren, and Ross Stores, a few others.
Xiaomi, the Chinese handset maker, TD, a read on Canadian banks, and of course, the brokerage business. Ross, we mentioned. Ralph Lauren will be really interesting, right?
Yeah,
because of the high-end consumer.
Yeah, and I wonder how it's holding up. I feel like Ralph Lauren kind of straddles that world between the luxury and then more kind of pedestrian,
But maybe you can buy it at Ross Stores.
Maybe. We also got some eco data, the weekly jobless claims numbers coming out at 8:30 a.m.
Yeah, and there's this sense that the job market has peaked. Maybe it's starting to roll over a little bit. So these high-frequency data points are really critical.
New home sales coming out at 10 a.m. Washington time, and around 3 p.m. New York time, we're going to hear from Atlanta Fed President Raphael Bostic. That does it for us here on The Close. Tune in to us tomorrow for all your coverage of all the market-moving events. Balance of Power up next in the U.S.